If you buy into the traditional logic of the stock market, investing seems fairly straightforward. A company generates record profits and its stock goes up. Their sales shrink and the stock goes down. By that logic, the memory chip manufacturer SK hynix should be the undisputed winner of this earnings season. They recently reported that their revenue jumped by 257% over the previous year, while their operating profit spiked an incredible 557%. Take a look at this chart of their earnings. You see this massive, undeniably strong spike in profit. But watch what happened the moment those numbers went public. Wall Street reacted, and the stock plummeted 9%. Now, let's look at the exact opposite scenario in Detroit. Ford recently announced a 4% drop in their total revenue, driven by a noticeable decline in their overall U.S. vehicle sales. This chart shows those downward-facing revenue bars. By all traditional logic, this is a clear miss. Yet, despite shrinking sales, Ford's stock rallied over 4.5%. We are watching a market that actively punishes record-breaking growth while rewarding shrinking sales. To understand why, we have to look past the top-line numbers and figure out what hidden metric Wall Street is actually using to keep score. The answer starts in the tech sector, specifically around artificial intelligence. Wall Street rarely trades on what a company did in the past. In highly speculative markets, they price stocks based on the expectation of absolute, flawless execution in the future. SK hynix didn't fail because their profit numbers were bad. They failed because they couldn't meet the impossibly elevated forward-looking expectations analysts had already built into the stock price. The anchor dragging down their profits comes down to a specific structural flaw in how they do business, the rigid nature of their long-term supply agreements. Look at this graph. DRAM spot prices shoot straight up from AI demand, but long-term contracts locked SK hynix in at lower rates, mapping a flat line. Analysts expected them to capture those high prices. That empty red margin gap is why they missed estimates. To see how you actually win the AI expectation game, we have to look at a company operating under a different pricing structure, Seagate. Seagate delivered a perfectly clean earnings report, headlined by 120% year-over-year growth in their EPS, or earnings per share. The primary driver here is data storage. As this calendar visualizes, the demand for Seagate's nearline high-capacity storage is so intense that they are entirely sold out for every remaining month of the year. Because they could definitively prove their future capacity to generate cash, Seagate exceeded the forward expectation threshold. The market rewarded that clarity, sending their shares rallying 6%. In the speculative AI hardware market, hitting a home run in your quarterly profits will get you heavily punished if Wall Street was already pricing in a grand slam. Let's step away from the abstract world of tech infrastructure and look at the physical economy. Down on the ground, the middle-class consumer auto market offers a completely different lesson through the lens of Ford. This scale illustrates Ford's strategy. On one side is total vehicle volume, on the other is EBIT. Ford let overall sales volume drop, prioritizing massive, expensive pickup trucks and SUVs over commuter cars to maximize the margin on each vehicle sold. In traditional manufacturing sectors, the market doesn't care if a company sells fewer total units, provided they can prove they have the pragmatic pricing power to protect their profit margins. But pricing power has a ceiling. To see what happens when a company hits that limit, we have to look at everyday household spending and evaluate the actual health of the average consumer. Take a look at this readout from Procter & Gamble's earnings report. This is their organic growth metric, measuring the physical volume of everyday household goods they moved. The line is completely flat at 0%. Flat volume means consumers are actively trading down to cheaper generic brands, or they are simply buying fewer items overall. The lack of growth is severe enough that it has forced P&G into defensive corporate governance moves, including transitioning their CEO to the board chair. If we compare P&G's physical goods to digital transactions, we see a similar strain. Visa just recorded over $4 trillion in total payment volume, largely driven by resilient spending and global events like the World Cup. Yet, as this chart breaks down, Visa's stock still slipped. To maintain their financial efficiency against rising operating costs, they are being forced into heavy restructuring, cutting 7% of their total workforce. When the everyday consumer taps out, even the world's largest staple companies are forced to rely on ruthless internal cost-cutting rather than actual market growth to appease Wall Street. The market is currently split down the middle. The AI trade has entered a ruthless show-me phase, where expectations are impossibly high. Meanwhile, traditional sectors are settling into a defensive crouch, prioritizing internal efficiency over expansion. In both scenarios, headline revenue numbers are nothing more than a smokescreen that distracts from the actual mechanics of how a business operates. To accurately read this market going into the second half of the year, investors have to stop looking at how much a company sold in the past. The only metric that matters now is a relentless analysis of how they sell their products and exactly who they are selling them to in the future.